Hello there. It's Richard Geller with Alan Schnur. How you doing, Alan?
I'm doing great, Richard. Thank you.
This is really an amazing module that we're doing today. What we've been doing is we've been studying Casa Bonita, which is a typical smaller deal for you that Alan is in the midst of has done and is working on. And this is kind of in the mid range here, 39 units, something that's not too small. So you're not competing with the guy that does duplexes and fourplexes and all that locally, and you're not competing with the big hedge funds that prefer to do 200 or 300 units. And these are very easy to finance. They're very easy to take down, as we say. And it looks like a gorgeous unit, but we're going to show you there's sort of a back end to this thing, which the this doesn't look so nice when you look at it this way, does it? Not quite. So there
And,
is.
and I just wanted to add too, as you see this rehab going on, everybody, this building's 100% full. So it's operating and collecting the money and cash flowing. We're going to talk more about that today. But it's a perfect situation when you can buy a small apartment complex, and while it's full, be able to fix the exterior. You just create this tremendous amount of equity. Everyone's going to see how we bought this for $950,000, Richard, and I'm going to put this on the market for 1.6 million in probably 2 weeks when all the exterior painting is done.
That's phenomenal. That's just phenomenal. So
So
that could.
it's. I mean, I bought this 3 4 months ago. I've been going a little slow because I had some other projects going on, but 3 4 months, I'll be in it for well, very little money out of my pocket. But again, $950,000 purchase price, spend around 20 30,000 in rehab, and throw it back on the market for 1.6 million, all within 3 4 5 months.
And you're going to see as we do this, you're going to see our rehab plan, Alan's rehab plan, and exactly how it gets done. You're going to be right here in uh, the 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 right beside the driver here, seeing how this is going to turn out, and also financially. So it's really fantastic. This is like one of the best apartment courses that, or if not the best that I've ever seen. And I'm not the guy here. It's Alan, and it's because of Alan. Alan, thank you. You're doing a great job, and we have a lot of people on. We have a lot of questions, and we'll continue doing the best we can. I just want to say we're just all in awe of your teaching and your help here.
And you know what's really unique about what we're doing with this course, Richard, is we didn't write this course out and then start making the recording. You and I are adjusting to this course as this rehab is completed on this project that I bought. So it makes perfect sense. This is the real thing. This is exactly what you're going to go through when you buy a small apartment complex. And so these ideas are coming up as the rehab is progressing, and we're going to talk more about that today. Some of the surprises that I encountered in the last few days, and some of the actual bonuses. I mean, we found 12 to 1,500 square feet that the builder didn't finish that we're going to turn into apartment units, and that's
Huh.
going to increase the value by another, I'd say, $50,000 to $80,000.
Yeah, that's phenomenal. When you can take a dollar and print $4 legally out of it, that's pretty cool
Yes.
stuff.
Yeah.
So to bring us back to where we are right now, what we've talked about is finding these deals. We've talked about finding them. We've talked about letters of intent and purchase contract and getting towards the closing. And before we talk about the closing, this whole module, we're going to be talking about getting your money together. We're going to be talking about finding partners, finding lenders. Then we're going to be going over the closing, and then we're going to be talking the rehab and the lease up, and then the idea of owning your own property management company to get in this full time and get paid as you go along. So this is a phenomenal, phenomenal course for you. It's going to be life changing, and we're even though I've had a lot of experience in this in the past, my wife and I are back into this game because we love this, and Ellen has been a great help in getting us going again. Because this is the best time in my whole life to be buying apartment buildings and be doing this to build more wealth. And so I'm in this with you. I'm learning a tremendous amount. So with that, let's get started. There's going to be all about finding the money. So it's about finding the money, and there's two sources of money, and I'm going to just call it partners or lenders. Partners are generally, people think, they're equity, meaning they get a share of the profits ongoing, and they get a share of the profits when you sell. And lenders who just want to get their interest rate and don't get any share of the profits other than the interest on their money. But there's also some in between that could be a very lucrative way to raise money where you're not giving up so much to a full equity partner, and you can raise money in a very advantageous way without actually giving away the store, so to speak. And Alan, you're going to be talking about that. And I will say that the thing that we are going to be talking about constantly today is how this is win-win, both for the investor, whether they're lending equity or debt. It's win-win for them, win-win for you. So everything we're going to do is always going to be focused on one thing, making a relationship that's going to work through the many, many years. Because when you get one partner, one investor, you could do a number of deals with that person, and you could be spending the rest of your life with that person, and both of you very, very happy and profitable because of it. And I'd say the secret of my success has been that I build those long-term relationships. And Alan, I know you, and we just spent a little time together last week in person, and I know you're the same way. You've got investors that go back years.
Yeah, and that's what we are looking for. We're not just looking for someone that's going to come and do one deal. I mean, occasionally that happens, but we're looking for the investor that's going to say, okay, you did good on the first deal. Let's see the second deal and the third deal, and you'll find that the investors, I mean, they get the frenzy. They want more and more, and it's pretty excited because a lot of people haven't been able to invest in apartment buildings until recently, or they don't know anybody in the business. And I mean, look around, step outside, look at all this real estate, look at all these apartment buildings. They're hard to get involved with, but once you get involved with and you find someone that does it really well, those investors are going to keep coming back for more and more. And I can tell you, I have some people that are in over, I want to say, 6 deals. My 6 last deals, I have basically the same investors in them. They just love it. They just keep rolling their profits forward, Richard.
Right, and that's my goal, to have exactly that. And I always have, and it should be your goal as well on the call, because you just need one person. You start with one, and you'll get more and more, and you'll build a life where you find a deal and you have the money automatically flow to you, just as Alan does. That's how you do 1,000 units or 2,000 units. That's how you build your lifetime apartment empire here. But to do
And
that, I think.
I was just going to say, if I can just add, I just keep on my Google, on my Gmail, I just keep my investor list, my preferred investor list, and let's just say there's 20 or 30 people that I really like. And when I have a deal, I mean, it's unbelievable. Within 5 minutes, I'm fully subscribed. People just say, yes, put me down. Soft commitment. It's fantastic. And this is what we want our listeners here to be able to do. I want you to build your list. And as Richard just said, it starts with one. And it just started with one for me as well.
So we've kind of distilled this down. When you're talking to investors, there's things that they need to know, whether you're talking to a lender or a partner. We're going to show you how to get both right now. But the first thing you got to do is you got to be able to speak the language. And we've looked at a lot of different terminology, glossaries, and things like that. But there's really like 4 things that you just need to master here. And anybody in apartment investing just needs to get these 4 things, and pretty much you'll be set. And we'll kind of explain each one. And last time we were explaining a little bit about occupancy rate, physical and economic. There's another term for the, isn't there another term for the physical versus economic occupancy rate? It's like
Um,
who's paid their rent, and who's late. Isn't that what kind of, or who's not paying, kind of what it amounts to?
oh, I see. Yes, physically living there. So if you have 100 units in a building, you physically have, and say 90 units are rented. Well, you physically have 90% physical occupancy. Economic. If you have 100 units and 90 people are living, and 90 units are full, and say only 80 of them paid, well then economically, help me out of the math here. Sorry, so if you have 90 units, 90 and 80 of the 90 is paid, so economically you probably only collected around 80%.
Right. Right.
So that makes it, you guys check that again. So normally you'll find physical and economic occupancy are not normally the same. So I mean, even if you're 100% full, 100 units, 100% full, you're 100% physically occupied. But if only 90% of the people paid, you're 90% collected. You're 90% economic. That's your economic occupancy, and that's what banks are looking for when
They
you're
want to know how
going
much you
to.
got collected, and it's a good sign
Yeah,
for you. It could be a good sign of the health of the building, one way or the other. I mean, I want to buy turnaround opportunities. I don't want to buy disasters, and I only going to buy in good
right,
areas. Again, I've bought in bad areas. We've talked about that. I don't want to do that again.
right,
But you've got to
right,
make
right,
sure that you might have a turnaround opportunity, and so there may be things that you can do, which we will be addressing to fix this up to get a bank loan, because the bank's not going to want a loan if the property is only 60 or 70% economic occupancy.
right. And and if the property is say 70% physically occupied, the bank knows that you're not going to collect 100% of the money, so they'll work that into their numbers, and it's okay. Normally, I see a 5 to 10% spread between the two numbers.
That's a normal spread. It might vary sometimes 5% up to 10%, but if it's over
Right,
10%, that shows a very significant management issue on the building.
right. Yeah, I agree.
Okay. All right, that's great. So that's occupancy rate. So and one of the things that we look for to be lendable would be what? About typically 90%, something in that range. 90 we said last time.
Yeah, yeah. So lenders, it's just the way it is. They really want to see that building 90% full for at least 90 days.
Right. So if it's not that way, there's things we're going to have to do to make the deal lendable by a bank, or not necessarily you can't do the deal. It's just done differently.
And I tell you what, this is a good segue, Richard, into the debt service coverage ratio,
Okay,
because
perfect.
if if it's not, this is how you get around it. This is one of my tips and secrets I'm going to share with everybody today. If it's not in the perfect lendable condition, most of the stuff I buy is not. If it's not 90% full for 90 days, what you can work out with the bank is you can find out what level is the bank comfortable with. And let's just say you were 10% short. Let's just say you were 80% full, and so you didn't qualify for the 90-day rule. So you can set aside X amount of dollars to make up the difference, and then the bank will give you your money back once you hit that 90-day period. So for debt service coverage ratios, we've escrowed, say, $20,000. We've escrowed it at the closing because it didn't meet the bank's lending criteria, but they understand. They know we're repositioning. They know we're going to get in there and do the rehab. They see the opportunity. They want to do the deal. So they say, look, you didn't qualify, but put X amount of dollars in this reserve account. And once you hit these numbers, we'll give you the money back. Do it all the time, Richard.
That is just right there, worth tens of thousands of dollars.
Yeah.
It's
Yeah.
going to be worth
Forget.
hundreds of thousands of
Thank you.
dollars to
Thank you.
me.
Yeah.
To me, it's going to be worth hundreds of thousands of dollars. So anybody using this information, that was it.
Right.
Just blew me away. So let's talk about what it is. What is the debt service coverage
Yeah.
ratio, or debt ratio, or debt coverage ratio, or debt cover? What is it? Let me see if I could just explain this in really simple terms, and then I want to hear your probably much better explanation, Alan. But
Okay.
basically, when you pay all the expenses on the building, other than making the loan payment, how much do you have left over? And the lender wants you to be able to make the payment and still have a bunch of money left over after paying all the expenses. That way, they feel like if some unexpected emergency happens or higher than usual vacancies happen, you've got plenty of cash to pay all those emergencies or those extra vacancies and not miss a payment. So they like to
Absolutely.
know that you have about at least one and a quarter times what's left over. At least one and a quarter. That's a minimum, right?
You got it. So $1.25 seems to be the industry standard right now, and the way I would also say it is the first dollar goes to the bank, so you're left with 25 cents. You're left with 25 cents to run the business, and the bank's comfortable with that number. I'd like to see our people get in there with like $1.75 debt service coverage ratio. So the first dollar goes to the bank, and the excess 75 cents would go to the person who owns the building to run the building and pay the other expenses. And basically, the bank's doing this because, God forbid, they take back the building. They want to make sure that they can operate the building and not just pay themselves. So we're in an upswing right now in the apartment industry. So the numbers low. So banks are comfortable. There's a huge need for apartments right now. So $1.25 is just another reason why everybody should be getting involved in apartment buildings right now, because the levels are so low. I could tell you back in like 2010 and 11 when things weren't so great in the lending environment, I saw debt service coverage ratios reach like $1.50, $1.75, and sometimes those are hard to find. So you might have an incredible cash flowing deal, but the banks aren't comfortable with the debt service coverage ratio, so they won't lend on it. There's tricks around that too. What you might want to do is ask for a longer amortization period, so it'll bring down your monthly payment and leaves more money to go around in the deal, but maybe we shouldn't go into that part just yet. Okay.
Well, the important thing, though, here is I want to just make something. The important thing is that what affects this is going to be your terms.
Yes.
Your interest rate, and this is a really important point, the interest rate and the amortization period, primarily.
And when you say terms, for example, okay, so when I'm thinking about terms, I'm thinking about interest rate, I'm thinking about amortization, and I'm thinking about a balloon, three things, and I'll go into them right now. Great lending environment, local bank, community lending environment right now. I'm seeing 4.5% to 5% for 1960, 1970 buildings and 1980 buildings.
Let me just stop you, if I could just make one point about this critical point, that if interest rates go back up again to the more normal, historically normal ratios amounts, that the people might be paying 6 or 7% instead of 4.5 or 5% for that building if they can't assume your loan. The point is that a 1 point or 2 point change in interest rates lowers the debt coverage ratios and makes it a lot of properties unlendable, or because if something's at 1.25 now, interest rates go up a point, it's all of a sudden at 110, then no one will lend on it, or the price will fall, and that's why this is critically important.
Right. I mean, there's urgency here. People need to get involved and finally do this and take advantage of these interest rates. I was listening to something interesting last week. We were talking about, it was on the radio, it was about the stock market and how some people are becoming very wealthy again in the stock market. But here's the thing. Most Americans aren't in the stock market. So the federal government is helping us, they're helping us two ways. They're helping the stock market go up, but they're also helping us by keeping interest rates purposely low. So this is how we can take advantage of what the federal government's doing here, is we can borrow money and buy apartment buildings.
Yeah, if we don't, and another way to put it is that people are on either one side of this or the other. They're either lenders or borrowers, and the borrowers are going to get the money. The lenders are going to be screwed. The government doesn't care about the banks being screwed because the banks create money out of thin air anyway. But if you've got cash sitting there, or your investors have cash sitting there that you've worked really hard for, that money is going to evaporate with inflation over time. So you need to borrow money. You need to leverage this and borrow cheap money that the government is subsidizing right now to buy apartment buildings. That's what I'm doing. That's what you should do.
Nicely said. Yes, interest rates are being subsidized right now, and you, as the investor, as a listener, the one who wants to buy an apartment building, can take advantage of this. Get yourself a nice 4.5% to 5% loan. Get a fixed rate, say, for 10 years. That's assumable. And when I say assumable, when you sell the building and interest rates are back to 7 or 8%, and you're selling the building with 5% financing, that makes it so much more attractable to someone want to buy your apartment complex. Because at the end of the day, there's more cash flow left over. And that's what we're doing here. These buildings are sold on the revenue streams and how much money they produce. It's not on your credit. It's not on the buyer's credit. It's how much money at the end of the day does the building make. The lower the interest rate, the more money you're going to make.
Yeah, so when interest rates go back up again, it may be very hard to sell a building without having a loan already on it. And if it's assumable, it's going to be much easier. Now, you also go for a fixed rate, Alan. Am I right on that? You don't go for variable rates.
Yeah. I am, over the last few months, I purposely decided to go for fixed rates or readjust into something with a fixed rate. I want to lock in. I felt really lucky over the last 10 years because rates have been kept low, but I'm starting to get this feeling that this invisible hand is going to go away and things are going to float up. As they float up, I don't want to float up with it. So when you get a fixed rate, you're locking in. It won't float. So I am going out of my way looking for 5 to 10 year money at a fixed rate, even if I have to pay a slightly more interest rate to do it. So I'm protecting myself for the future.
And the other amortization period, we just want you to be familiar with a 10 due in 30, for example. What would that be?
Um,
If,
so
that would mean that you'd have a
help me out.
loan due in 10 years, but it's amortized as if it was a 30-year loan. And that's pretty common. Those types of terms are pretty common, are they not, with banks?
They are. I see what you. So, and I call that a balloon, just so you know. Um, so basically, when we amortize a loan, I can tell you what's really popular right now. Um, we're seeing a lot of 20, 25-year amortization schedules, which is great because you get to spread out the payments over 20 or 25 years. But here's the catch, the balloon part of it. The balloon part of it says this loan is due in 5 years, or this loan is due in 10 years. Even though it's due in 5 or 10 years, we'll be kind enough to stretch the payment schedule out over 20 or 25 years. Does that make sense, Richard?
Yes. I did this wrong. 30 due in 10 is what I meant. No wonder it sounded confusing. Sorry about that.
Okay, no problem.
So that means it's
Um,
amortized. The payments are lower because it's as if it's paid off over 20 or 25 years. But in 5 years, the bank calls the loan due in full. That means you have to find another lender, or the bank has to be willing to roll that loan over. Trouble with that is that mostly the banks will roll it over, but they could roll it over at a much higher interest rate in 5 years. Or
right, and we call that maybe locking in for 5 and then adjust 1 point above where the market is on the 6th year. Because I don't want to feel we call it naked. At the end of the 5 year period, God forbid I can't find refinancing or the world's changed. I want to know, worst case situation, will that bank still be there for me? And want to make sure it doesn't call the loan. I don't want to lose
now,
the
I
building.
will, I will say though, it happened to people in 2008, 2009, 2010, 2011. What happened to a lot of people is they did get called, even though the bank had promised not to, or whatever. The bank just called the loan because they have all this fine print. So there's always a risk of that. If you have a loan due in 30 years or 20 years, there's no balloon payment. You don't run that risk, that rollover risk, which you
Wait.
do.
Let me jump in here because this is what I'm seeing now. So because people learned from what happened 5 years ago. So again, you might get a 5 year balloon, but you can get a 5 year balloon, but you can say years 6 through 10, you can adjust a point to where the market is. So
Okay.
you have 10 year financing in place, and that's how I do it. I mean, of course, I'm trying to get 10 year balloons and not 5 year balloons. But look, sometimes some of these 39 unit deals that that are down the block from you, you got to move quick, and you take the 5 year balloon and if you don't like the terms of your loan, well, go shopping for a new loan. You have 5 years to fix that problem, but you got to start somewhere, and you have a huge equity play. You can buy something for $950,000 like Casa Bonita, and I predict it's worth $1.6 million. I'll take that 5 year balloon, and I'm either going to sell the property, that's the plan, or maybe in the middle of the loan, years 2 or 3 or 4, I'll decide to go refinance it.
Yeah, so I'm very comfortable with that, Alan. I'm very comfortable with that. I'm not comfortable with 5 years because the we call systemic risk. The whole system kind of
Right,
collapses like it did in 2007 and 2008 and
right.
thereafter. Everybody gets hurt, but 10 years is a good window. And so this gives the bank the 5 years that they want, and then gives them the additional time, gives you additional time if you need it to avoid that systemic exposure to the economic system that we've seen can be a problem. That's a great
Absolutely.
another that's
Yep.
another point that's worth hundreds of thousands of dollars right there. Okay, so
Yeah. No, you're right. You want to make sure. I mean, banks won't. They'll give you that. You just have to ask for it. If you don't ask for it, they will not give it to you.
one more thing that I want to mention here is that if you do actually decide that you can go with agency loans, meaning FHA, Fannie, and Freddie, then you can actually get loans that have no balloon payment. And this is not an issue, but they take a lot longer to fund in many cases, and they can be a lot more paperwork and more hassle. But for some deals, you may want to do that. And there are FHA loans where a lender will make a bridge loan like within a few weeks for you to buy the property, and then over the next few months the loan closes, or the next 6 months, which it may take for the loan to close, and then you're getting a that bridge loan is paid off by the permanent loan, and that has no balloon payment. So that's the nice thing about government loans is they have no balloon payment. One of the
Yeah,
many.
I do them all the time. It's fantastic.
Yeah, but not quick, not quick. So
It's not quick, but again, so what somebody can do to get into the deal, work with your local bank. You might need a quick close. Do that, get comfortable, fix the deal, create this equity, and then when everything's under control and you have some time, you can then begin the Fannie Mae process.
right. And so what affects this debt coverage ratio, which is really a key, is going to be not just interest rates, which we don't have a lot of control over, but how much income are you making on the building? That's really the bottom line. The reason that you're able to sell that Casa Bonita potentially at 1.6 million or whatever is because the building is a lot more NOI, net operating income, and therefore the not only is the building worth more, but a lender will loan a lot more money on the building. So that's the
Absolutely. You
key.
know, at the end of the day, it's easy. It's like any business. You want to raise the income, lower the expenses, and you're left with a profit. And it's so easy, and it's psychology. I mean, do you want to do that with a single family house that you buy for $30,000 to make a few thousand, or you can do the same exact idea with a 39-unit building but make a $500,000. It's totally possible. Raise the income, lower the expenses. As we say, slap some lipstick on the pig, which is just paint it, carpet tile, fill it up with some good people, give it some loving, tender care, and everybody will appreciate what you're doing. You'll get the right interest rate, you'll get the right amortization, and you'll get the right balloon period, and you'll have, you're going to have plenty of time to decide what you want to do with the property because you're going to have everything under control because now you know 90% more than what people will ever know who buy their first building that know nothing about nothing.
Right. Well, yeah, because there's two things we've already talked about today, which are life changes for you that change everything. Almost nobody investing in apartments knows. Now, I want to move over to. Should we talk about cash on cash returns now? Because this might be a good time to move right into that.
Yeah, that'd be great.
So that's really, really simple in concept. And the concept is that let's use an example, a very simple example. Let's say you're buying $1 million building, and let's say that you and your partners are putting in $250,000 down. So that's $250,000 in cash that you're putting down. Wouldn't you like to see a return on that money that would exceed what you would get in the bank? So let's say that it's 6% would be a reasonable return. So $12,500 a year, is that 6%? Um,
No, 6,
Sorry
12.
about that. That's 5%.
That's okay. It's probably like 14.
Yeah. So this is a good time. So you go point oh
That's what I was
six
doing.
times 250,000. We should share that arithmetic with our here. All right. And so it's so that's actually the arithmetic is if you want
15,000.
6%, you go point oh 0.06 multiplied by $250,000 equals $15,000. It's helped to know a little bit of math here, but like I don't, but it helps to know a little bit. 6% is times is 0.06. That's basically it.
Yeah.
If you're getting a $15,000 return, let's say through what's left over at the end of every month, and you get a bit of profit every month that you can take out of the business, or even if you keep it in the business, if it shows an income of $15,000 a year, That is the equivalent of a 6% cash on cash return. What's a pretty good cash on cash return these days? I mean, a reasonable one. Reasonable.
I wouldn't look at a property. This is me. I'm looking for 10 to 15% cash on cash return. And I just found that my investors or the people that I'm meeting, the new partners, they get really excited about those numbers. I mean, we all know no one's making any money in the bank, and you're not even making a tenth of a point in the bank. And we're just talking about cash on cash returns. We're not talking about all the other benefits of real estate. We're not talking about the values of the building going up. We're just talking about send me a check once a month. And that's what we actually do, Richard. We send out checks in this business. Promoters, I guess you can call me a promoter, would send out a check once a quarter to their investors. I wanted to do things differently. I decided to send out checks once a month. So once a month on everything that I own, we send out checks. People, I mean, it's real. People, it's income, it's monthly income, and they can see their cash on cash return every month. They absolutely love it. I would suggest that our listeners do the same thing. Send out payments once a month.
Yeah, and so I want to point this out just to emphasize this. Cash on cash is going to be the amount of return on the down payment if it comes from your investors or wherever it comes from. There's going to be a much, much higher return on the overall building. For example, let's assume that Alan here has a 10% cash on cash return that his investors are getting. That means that he's over the year, let's assume a $250,000 down payment. Over the year, he's going to pay them out at roughly $2,000 a month. He still might have 1,000, 2,000, 3,000, 5,000 a month left over because he's getting a return on the entire building. This cash on cash return is just the return on the amount of actual cash that people invest, the amount of that goes for a down payment or rehab, wherever it may go. And when the building is sold, if the building sells for 1.6 million, Alan has, let's just say, a $600,000 profit. That's that's a lot more than a 10% cash on cash return. So, but it's important that you know this because investors look at it as how much am I giving you and how much am I getting back. They don't care about the black box. They don't care about all the rest of it, really.
So what I find, when I meet new investors for the first time, I know what's on their mind, and basically what they're thinking to themselves: how long will it take for me to get my money out of the deal? Every investor wants to know that their money's safe. What was that? Was that Will Rogers saying? Don't tell me about the return of my investment. Tell me about the return. I'm sorry. Don't tell me the return on my investment.
Yes.
But tell me about the return. Well, tell me out, Richard.
Tell me of the return of my investment.
Yeah.
Don't tell me what you're
Yeah.
going to return on. Tell me how you're going the
Right.
return of my investment. And another way of putting this is I like to think about this is this way. I love to travel, so I have to get on airplanes a lot. And when I travel on an airplane, we get up in the sky, we go really high. But the next
Right.
problem is how we're going to get back on the ground. And like the first thing a pilot needs to know is how they're going to get safely back on the ground. Investor, the
Right.
first thing they want to know is it's called an exit. EXIT. Here is the key word for you to know in pursuing an investor
Yeah.
is what is their exit? How are you going to pay them their money back? And
Awesome. Let me tell you a real scenario that I'm going through right now. I bought a building with a local bank, and I have partners. Let's go through the entire scenario. I'm going to round the numbers off. Let's just say I bought $1 million building, and I needed, say, $300,000 to do the deal, so I can do the rehab and have money in the operations account. So the bank lent us $700,000, and my investors put the other $300,000 up. All right, so the deal I make with my investors is it's 50-50. I'll go get the bank debt. The investor puts up the $300,000. I own 50% of the deal.
okay.
Okay, so not only now is this cash flowing, cash on cash return of 10% a year. So let's just say 300,000 up. It's returning $30,000 a year.
Mm-hmm. So
Here's part of the exit strategy that is popular, and I want to share with everybody. I'm in the process of refinancing the building. Now, this particular building we're not selling, but during the refinance period, the valuation is up because I fixed the building. It looks great, and it's cash flowing, I made the 90-day rule, 90% occupancy, 85% economic occupancy collection. Um, so the bank is going to, on the refinance, the bank is not only going to pay off the first bank, the 700,000, but they're also going to pay off the other 300,000 that I put into it. So the second bank's going to lend us $1 million because they think the building's worth 1.8 million.
So that's
So
going to
all
pay
the
off the
investors
seven
got their
hundred
money.
thousand dollars from the bank, and it's going to pay the
Yep.
$300,000 to the investors.
So the first bank's out. The investors get all their money back. So now their cash-on-cash return is unbelievable because they no longer have money in the deal, so it's an infinite return because we still own the building, and the valuation is up.
And so they
Makes
owned
sense?
50% equity in the profits in the building as well.
They did. I
Okay.
mean, that's just how I structured my deals.
Mm-hmm.
I find the deals, I run the deals, I have the property management company. We're going 50-50. Investor puts up the money, I'll go find the bank debt, and the bank put up 700. I signed my name on it. The investors put up the 300,000 cash. They agreed to leave it there for as long as I needed to. The exit strategy was, let me fix this thing, let me fill it up, let me cash flow it, let me paint it, and then we'll bring in a second bank and we'll refinance the first bank out. And when I'm doing that, we'll get the excess money from the refinance, pay off the investors, they have their money back. We're in this deal now, no money down. And it's worth 1.8 million, and we bought it for $1 million.
And
So
I
we have
want
a
to
new $1
ask you
million.
a key question here. Okay,
Yeah.
you found the property, presumably. You put the deal together, presumably. You're managing it. So what about earning your daily bread for all of that in the meantime?
Yeah. So my property management company, we take 5% of the gross collected income. So again, let's just do simple numbers. Let's just say it collects $40,000 a month in rent. So we take a 5% fee of the 40,000, which is I guess what is it, $2,000 just for overseeing the people that work at the building.
Mm-hmm.
So and then there's other ways of making money too. If certain repairs have to be made on the building, we take a 10% override in construction. Property management business, I'm absolutely loving it. And once our listeners get comfortable with buying one or two buildings, they'll find that it's a very scalable business, and it's easy to do. And you can go from 39 units to 3,900 units, and that's a personal goal of mine. That's what I'm working on. But look, we're talking about exit strategies right now, and I just shared with everybody a strategy how eventually you can have no money in a deal. You find $1 million building, you raise $300,000 from your investors, you go get a bank loan for $700,000. You're in the building for $1 million right now. You fill it up, you fix it. You're cash flowing, cash on cash is in place. You've met your 90-day rules, and you want to go refinance. You raise the value of the building. Appraiser says it's worth $1.8 million. You get a new debt. You get a new loan in there. I've actually walked away. I've had situations where we paid off the $300,000 to the investors. We paid off the $700,000 to the first bank, and the new bank wants to lend more than $1 million. They want to lend $1.2 million. Now there's $200,000 of free, tax-free cash.
Me
that
too.
we split up.
Done it too.
Yeah.
Yeah, it's the best way. And I want to say that if you have $300,000 yourself, you can just do it yourself, and you don't have to give up any equity if you wanted to. Then you get your money back. Then you take that and you do your next building. See, so we're building your empire. If you happen to be fortunate and have, or your family and has a bit of cash, you can just, if you want to do it that way, you can. So
And hey, you just next time we need, because cross collateralization, it's a great real estate strategy. I've seen people build hundreds of millions of dollars of real estate empires with using cross collateralization, and let's definitely go into that next week.
yeah, that's a good point. And I want to say too that sometimes it's a bad idea, and sometimes you want to be really careful about this. because the people whose real estate empires have unraveled in the past, they got caught in a big downturn, highly leveraged with all this borrowed money and cross collateralization. So it's a double-edged sword for sure. And so there's different levels of conservatism. Now, the conservatism of using other people's money this way is very conservative. Might be a lot less conservative if you're investing your own money and you're pyramiding and all that, because at some point, if there's a downturn, you can be very exposed. And that's what happened in the last crash of properties with people that were highly leveraged with their own money. So I just want to point that out because
I
you may
agree.
want to choose
Hey,
them.
I also want to point out too, since we're using $1 million building as an example, um, I charge an acquisition fee, and it really it's a great source of income for somebody who wants to get started in apartment buildings. Acquisition fees are anywhere from 3 to 5%. And let me give you an example. You find $1 million building, it's okay if you tell your partners that are investing in it that you got to get paid for your time and your work and your effort. So I take a 3% acquisition fee. So that's $30,000 that you walk away with at closing. So you have no money in the deal. You own half of the building, and you're going to take a management fee, and you're going to take a construction fee of 10% while you're doing the rehab, and you're going to get an acquisition fee of just say 3% at the close. You're going to go home with a $30,000 check.
And if you're managing this yourself, you're going to get a 5, 6%, 7% management fee every month on the rents.
Yeah. I mean, I charge, yes, we charge 5% here in Texas.
Yes.
Management fees are anywhere from 5 to 10% across the United States. Yeah, so it's great. You're watching your investment. You care about it. So, I mean, you can easily turn a small building. Not only can you make hundreds of thousands of dollars on a small apartment complex, but you can create this monthly cash flow that you need in your life from one of these small buildings by creating a partnership. I mean, you can easily create. I showed you how you can make $2,000 on the management fee. You get cash flow every month out of the building anyway. So, I'm expecting you'd make at least $2,000 or $3,000 that way. You can easily make, let's say, $3,000 to $5,000 a month on a small apartment building if you follow what I'm saying here. And that's just one building.
So you're getting paid to be in the apartment business, and you're not putting any of your own money in. So there's.
You just get to the point. Then you say to yourself, how many do you need to own? I mean, what's your monthly number? Is it $15,000 a month? Is it $10,000 a month? Is it $5,000 a month? And just there's your plan. If it's $10,000 a month, go buy 2 40-unit buildings.
Yeah, and you don't need your own money now.
Exactly.
Well,
I'm sorry, I'll say one more time. You'll leave the closing table with money.
Yeah, no, that's so critical. Let's talk about cap rates now to complete our discussion. And
Okay.
then we'll talk about, maybe next time, we'll talk about how to find your partners and how to find your banks. And then we'll move to the closing and the rehab. So cap rate seems to confuse a lot of people. And I want to say do you want to talk about what it is, or do you want me to take a stab at it
Yeah.
first?
Why don't you take a stab at it first, and then I'll tell you the way I actually use it in the apartment business.
Okay, here's what I look at it. Here's cap rate. It's like really the most important concept for valuation purposes for almost everything in apartment building. So the first thing that we want to know is this. Let's assume we pay cash for the building. The entire building, we just paid cash for it. What kind of return would we get from the building every year? Just like assuming the building was like a bond or a loan, how much would we get out of it every year? How much would it pay us to own it? So if we go with a $1 million building, let's say that we get $100,000 a year out of the building that's left. If we paid $1 million cash, we got $100,000 out of the building. That would mean a 10% cap rate. It's yielding us 10% to own it.
I agree, and that's folks. I look at cap rate as just an interest rate. I don't know. I just call it. I mean, so Richard just said a 10% yield. Right now, across the United States, we're seeing, let's say, like A-class apartment buildings, new construction that you see going up all over the United States right now. Those are like 3 caps. And what does that really mean? Um, it means that someone's making a 3% return on their cash on cash. 3%. If they paid all cash for a new building, they're getting 3%. Here in Texas right now, on the stuff that I'm buying, I'm seeing 10 caps. So what does that mean? I'm getting a 10% return. So it's really just an interest rate to me. Richard?
Here's where, yeah, and here's where it's really, really critical. Couple of concepts. The higher the cap, the higher return. And so what that also means is that the nicer the building, the nicer the area, the lower the cap rate. So what Alan said, on a brand new building in a really nice area of a three cap might be typical. But if you take a building that is sort of a turnaround situation and it's in a nice area, but it's not like super premium and it's a B or C or D, it might be an 8 or 10 cap. So the higher the cap, the higher the perceived risk on that building, or the more of the pain in the ass that building is to own, basically. And
Yeah, absolutely.
yeah, and cap rates vary here. You need to know cap rates because every area has certain prevailing cap rates, and every building type within that area has a prevailing cap rate, and that is what determines purchase price. And so a lot of times people say this is a big mistake that beginners make. They go and they look at the a building that's being offered, and they look at the purchase price and the asking price seems too high. But what you can do in this business, and I don't know if you do this, Alan, I'm sure you do this all the time, is you basically take the financials on that property and you calculate the cap rate. Based on the cap rate, you calculate a purchase price. And usually it's a lot different than what the seller's asking for. And then you can make your offer. You can write your letter of intent, your LOI, based upon, hey, here's the story. Here's what the cap rate is. It's about 8% for this type of building based on that. And the rents that you said you get and the net operating income. This building is really an $800,000 building, and that's my offer. So everything's
You got
based
it.
on, yeah.
Yeah.
So you need to know the cap rates. How do you find that out?
What I do when I'm going into a new area, I start talking to the brokers, and I'm asking them what kind of cap rates are they seeing in their area, just to help establish a base. So real estate brokers, um, local bankers are going to know the cap rates in the area, and markets in Millichap. I mean, a lot of the national brokerage companies, they put out listings of cap rates all across the United States.
So looking at it
So
this
this
way,
information is you can find this information on the internet, on the web, but again, or LoopNet. So if you find a property on LoopNet, that's where you go. There's thousands and thousands of apartment listings, and you start chatting with the broker. You can just might ask them what kind of cap rates is that particular broker seeing in that area. It's going to make you sound so smart too. And again, I mean, 90% of the people don't use this kind of language, and they should. It's really creating a commonality. Once you start talking about a cap rate, an 8 cap or a 3 cap, or like if I say 10 cap in my area, someone's going to know right away I'm talking about a 1970, 1960 building, higher risk. If I say a 3 cap, they'd be thinking, okay, Class A, 3% return, safe. So a cap rate tells a lot about the type of person who's buying the product.
yeah. So if it was and this is just imaginary, if it's an 8% cap in the area for that building type, and it's a $20,000 NOI, you do 20,000 divided by 0.08, and you get $250,000. That would be the value of the property based on that, based on the NOI that the seller is representing. So
Yeah, yeah,
that's it.
yeah. So actually, you're right. I should have used the formula. So if you divide some people want to know how to analyze and figure out what a building is really worth. The net operating income basically is, I don't want to get too complicated here, but the NOI income is not including any mortgage payment. So let's assume you buy the building for cash and not including any kind of big capital repairs you'd make. So basically you would take, for the sake of this conversation, you would take the profit and you would divide it by the sales price, and then you would get your cap rate. And if somebody was trying to tell you that the cap rate was, say, a 4, and here you found your profit, you divided it by the sales price, and you're getting a cap rate of a 2, right away, you would disqualify. You would say, these numbers don't add up. Are you sure about your sales price? You're not making that kind of money to command that kind of sales price. Sorry, Richard.
So that would be, if in your
Yeah.
example, that would be asking a $500,000 sales price, because you go
Yes.
$100,000 divided by the cap rate of so that would be so a cap rate of point of 2 would be uh I'm sorry, did we say
5 billion.
I'm sorry, 5 million, right? There we go.
So let's just say someone had $100,000 of NOI, and they were trying to sell it on a 2 cap. They charge a $5 billion.
But you're going to say, but the broker says, well, this is a 4 cap building in a 4 cap area. Remember, if the
Let's do
building is
that. So then
brand
we're going to divide
new, and
100,000.
so that would be a whole different story. $100,000 divided by
Yes, we do.
0.04, $2.5 million. So we're kind of
Yeah.
far apart. So when you want to offer $2.5 million.
Yeah, and all you have to say is, look, this is what this building's making, and this is the cap rate. So this deal's not making sense. You're asking me to pay, twice as much as it might. The property, what I find in this business, the property might actually be worth that, but the income level is off. And I only want our listeners to buy on income level, not pro forma. Pro forma is
Historical income rate. That's the point, is what it's really done,
yeah,
not what they say it'll
right,
do. And we get so
right,
many of these idiot brokers and people trying to pull the wool over our eyes, sending us pro forma BS.
right. So we're buying an actuals, okay? We're just buying an actuals here. Good stuff. Good stuff.
All right. Well, I think we're done for today. We've talked about a lot of
Okay.
ground. And next
Yeah.
time we'll talk
Information
about,
overload.
yeah, yeah. And I know this is probably one of those modules you're going to want to go over several times, because we just, there's no way around it. But I think we've covered some extremely interesting things, very key things that most people never ever discover. So next time, what we're going to show you, let me just give you a real quick glimpse of what we're going to be talking about next time, so you can get really excited about it. And I want you to really study this module as much as you can. So next time we'll talk about finding partners and finish up on finding lenders, and then we're going to move on to the closing and then the rehab.
Perfect.
Thank you so much. Really appreciate it. Thank you very much, Alan. Thanks, everyone.
All right, Richard. Lots of fun. Talk with everybody next week.
Talk to you soon.